If ever there was a time that you needed our advice the most, it is right now. It is right now because we firmly believe that you too are left untouched. Untouched reading headlines such as blood on the street, bear attack, oil bears the brunt of Russian attack, crude oil price hits $103 as Russia steps up the Ukraine invasion. And these are those moments where you need somebody to be your mentor, to be your guide, to tell you what you need to do. Because if you go and see your portfolio, I'm sure most of the stocks, most of the holdings will be reading red, dark red. And you must be seeing some of the stocks fall as much as 4 to 5%, and some of the stocks go even to levels of about -8, -10%. This was what happened yesterday on the 24th of February. With this, you're wanting somebody to come and tell you what is the thing that you need to do, because in somewhere in your mind, you're saying to yourself, I need to limit my losses. And the only way that you can limit your losses is to sell something and run away from the market till everything settles down. I urge you as a friend and as a coach and as a mentor to not do anything unless you watch the entire episode today of Informed Investor, by the way, which is being released off cycle. Normally the episodes come to you on Sunday morning. And thank you for the overwhelming response. Your encouragement means a lot to us. This is a special situation and hence a special episode released at a special time. Hope you take the action only after watching what we are telling you. And we will leave you with the facts, with the data, hoping that you will make the right decision, a decision which will not come back and haunt you and bite you in your times to come. You're watching the Informed Investor Third Empire, an initiative by Research and Ranking. Let's begin. There is one thing common with the stock markets and geopolitics. Can you guess what? Well, both are unpredictable. Why, you may ask me? Because on one side are the fundamentals, which are the long-term aspects of how you deal with markets and people, the geopolitical relations as they call it. But on the other side, the same people drive sentiments such as greed, such as fear, such as panic, such as mood points. And these are the emotions that people drive in the short term, because of which the markets react the way they reacted yesterday. As I say, in short term, it is the emotions that really drive the market. In the long term, it's the fundamentals, of course. Now, there are various videos and headlines that have been released on YouTube, some of which I'll ask my colleague to show it to you on the screen, because if you were to go by these headlines, then we don't blame you. We don't blame you in selling your holdings. Because in your place, if I see these headlines, I would be tempted to believe that the world is coming to an end. And if the world is coming to an end, then of course there's nothing more to do than to sell your holdings and run away. These are those headlines which you are privy to, and so are we. Because when the market nosedived yesterday, in fact, I'll thank my colleague Merlin and Raj for bringing these facts to me. In fact, whatever that you're going to be hearing is something that they've helped me quite a lot from a content standpoint. But see the table that is appearing on your screen now. This is the table that depicts what happened on the 24th of February 2022 during the first hour. 103 billion worth market capitalization was just eroded, washed away. In fact, India was a country which had seen the maximum impact of what happened yesterday. You see that table? A minus 3.46. Well, this was the case of Sensex, but Nifty too fell like a pack of cards. Nifty, day before, ended at 17,063 levels, and yesterday it shaved off 815 points to end the day at 16,247, which is nearly 5% fall, or to be specific, minus 4.78%. Minus 4.78% on one single day. And you must be wondering, the heavens have fallen. Well, it's just not yesterday. In fact, if you see the past few days, and this is where I'll request my colleague to pull up a slide. Okay, can you see that? Now, these are the slides that depict, or this is the table that depicts what has happened to the Nifty 500 set of stocks and NSE set of stocks. Now, look at this table very carefully, and in the last row at the bottom, can you see that row? This row says that 25% of the Nifty 500 stocks have corrected by as much as 31 to 60%. You heard me right. 31 to 60%. 25% of the Nifty 500 stocks have corrected. Not only that, if you see one ladder above, which is that 30% of the companies of the Nifty 500 have corrected as much as 21 to 30%. And these are not small numbers. Now, if you were to see some very, very accomplished names, right? For example, there are three categories, and this is a chart that I want to see you, which should appear on your screen now. Great, thank you. Now, great quality businesses like Abbott, like Avenue Supermarts have also corrected by 20 to 30%. There are some of the well-known names which are otherwise darling, sort of stocks of investors. Something like a Deepak Nitrite, something like a Dixon Technologies and IRCTC, they've fallen to the tune of what, 30 to 40%. And of course, if you were to look at the pack on the extreme right, you would see that stocks such as Strides Pharma, such as Solara Active Pharma, such as Sequence Scientific and Metropolis Healthcare have fallen to the tune of 40 to 60% from their peaks of 52-week high that they had achieved not so long ago. So if you're thinking you are the only one and your portfolio is the only portfolio that God has not been kind to, well, these are the facts that you should keep in mind, that as an investor, these cycles will ultimately come. This is where your patience will be tested. This is where you will be tested. This is where your resolve will be tested. And this is what separates a really informed investor from one who's reactive, right? Now, that being said, I'm saying this very, very confidently that when this crisis ends, and of course every crisis ends, when this crisis ends, there'll be a bunch of people, in fact, a majority, a lot of people who would have ended up losing quite a lot of money, okay? People would have lost fortunes that they would have accumulated since 2020 mid, and they would have lost everything, right? Because they sold everything and ran away and wanted to buy at fresh levels. But there are some people out of the lot that are watching the episode even now who would have made a fortune and mountain loads of money from this crisis. Okay. Now it's a matter that can be said to be one where we're trying to present opportunity in a great tragedy where there is human life loss. Don't get me wrong on that. All I'm saying is that these are the moments that will test your resolve, that will test your patience, and this is where a little bit of hand-holding goes a long way, and a little assurance goes a long way, that ultimately comes to the fore. Now, why am I saying this? Because please believe me that companies which are listed in NSE or BSE will not be doing something different today or tomorrow. Bajaj Finance will continue to lend to consumer, to retail customers. It will continue to be doing its lending to SMEs and commercial enterprises. Asian Paints will continue to be marketing paints, their home decor solutions as such. United Beverages will continue to be selling the alcoholic beverages, including Kingfisher beer and many other drinks, by the way. The irony is that some of us would be holding in the evening and then trying to say, what the hell is going on with the Russia-Ukraine crisis? The business will move on, and so will life. But this is where emotions will take the better of the common sense that needs to be prevailed as an investor. Listen, we are saying this because as investors, at least the group that we represent, Research and Ranking, has seen all these cycles. No, we've been there. We've done this dozen times, right? We've invested through the wars. We've invested through the terror attacks, the financial crisis, the health crisis. We've seen the inflation crisis. We've seen the currency crisis. We've seen the political crisis. We're seeing one, which is the geopolitical crisis as well. So we've been there, done that. This is the level of confidence that we are coming back to you and saying, you should take some facts in mind. So some of you must be thinking, हो गया ना भाई, अब जो तुमको बोलना था वो बोला, अब थोड़ा facts भी बताओ ना, अब करना क्या, right? What should I do? Well, this is where I like to come to you with facts and data that you should consider. I'm not saying that you should buy or sell stocks today or tomorrow. I'm just asking you to consider the facts. There is a study which has been done on the past 29 different geopolitical crises, starting from World War II. Past 29 geopolitical crises, starting from World War II. And the facts that have come up are startling, are amazing, are mind-boggling. For this, I would need my colleague to show you a table, right? Can you see this table? This table is basically showing the S&P 500 performance after geopolitical events, after the events. It's a huge laundry list which starts from as early as May of 1940. We don't want you to go there. Probably some of us were not even born, at least I was not. But let's go to the relevant ones. Let's pick an event in the 1990s. Let's pick an event in 2000-2010 period, and let's pick an event in 2011-2020 period. So we have one event from every decade that we can talk about, okay? Now, before I talk about the event, the key takeaway from this study was that within 3 months, most of the stocks or all of the stocks had entered into a positive territory. In fact, 66% of the stocks were in green within the first 1 month. Right? Let's pick three events, including an event which is very, very close to what has happened yesterday. Let's pick the first event. This is the Iraq invasion of Kuwait. When did this happen? This happened in August of 1990. Can you see this on your screen? This is highlighted. Yep. Now, what it says is that 1 week, 1 month, 3 months, 6 months, and a year after this geopolitical event happened, what happened, right? In fact, when the Iraq invasion of Kuwait happened, within that given week, the indices, S&P 500, had fallen by minus 3.3%. But a year down the line, from the day that this invasion happened, the indices were up by 10%. By 10%. And you must be scratching your mind, God, had I been given this knowledge and this wisdom, I would have invested during that time. Well, no problems. Let's go to the second one. This is the Iraq war in March of 2003. Now, what happened? In the first week the event, the markets of the Iraq war, S&P 500 I'm talking about, had fallen by minus 0.5%. But, interesting thing, in the 3 months period following this event, the markets, S&P 500, had risen by as much as 16%. And at the end of 1 year period, the markets had gone up by 28%. Do you believe that? 28%. Right? Now let me come to the most relevant one, which is the third event, which you should be seeing on your screen, which is getting highlighted. Yes, Russian invasion of Ukraine. Now you must be saying, "Ye to kal hua tha. This happened yesterday." And this is not the first time this has happened. Russia has not invaded Ukraine the first time. This is the second time it has happened. The first that happened was in February of 2014. Can you see this on the table? Yep. This is basically the invasion of Crimea, right? Crimea, where ultimately an annexation was done, and Crimea was not awarded, but snatched away by our dear friend Vladimir Putin and his forces, right? Can you see that? Now, what am I trying to highlight over here? That even in this given event, S&P 500 had gained 8.3% in the first 6 months and ultimately had ended up gaining close to 15% since this invasion of Ukraine happened by Russia. Are you understanding what I'm saying? Take a pause and try and understand what I'm saying. That Russian invasion of Ukraine led to the S&P 500 performing 15% better the day this invasion happened. Now, please see one more table, and this is where I thank my colleagues, because if you see this table represents what exactly happened in the Russian context, and this is where the Russian invasion of Crimea on that particular date of 3/3/2014, right? S&P 500 on that given day had fallen by minus 0.7%. Within the first 5 days, it had risen by 1%. The MSCI Emerging Markets Index had fallen by 2%. on the day this event happened. And within the 5 days period, it had again come back to its norm. Now, what I'm trying to say over here is, of course, before I come to what I'm trying to say is, keep in mind that the overall equity exposure that Russia has in the MSCI index is just about 3.2%. And in the global indices, it is about 0.4%. Ukraine, it doesn't have a bearing or any impact in these indices. Now, what I'm saying is that the odds are stacked in your favor if you stand by time and you allow time to heal the wounds. Because with time, it is for sure that any geopolitical event will also lead to the markets not only gaining momentum, but going past the expected mark as such, right? Now, history does suggest that that geopolitical events should be taken as a temporary setback and a great opportunity for you to invest at the right time. Now, you must be kicking yourself and saying, why didn't I invest yesterday? It's not your fault. In your place, somebody else who's not as informed would have done the same thing and would have in fact sold. Forget investing. This is where you need to consider data. Please, for heaven's sake, look at the data. Wear a very, 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 very cool mind and then decide what you want to do, right? And this is where we say that though there is no assurances and guarantee in the stock market, but there is one thing which is 100% guaranteed in the stock market, which is that the market eventually corrects from geopolitical crisis and crashes. This is a certainty. With time, it surely does. And you must be thinking, great, we've got the point. Now what? Well, now what? You're still worried about inflation. You're worried about interest rates as such. Well, that's a very, very valid point, because inflation is something on the back of commodities, on the back of crude, on the back of wheat, on the back of copper that we see will ultimately shoot through the roof. Let's not kid about that. But this is something that you're asking will be the course ahead. Well, to answer this question, let's put the universal truth on your screen right now. Can you see this? The universal truth is that if crude increases by $10 a barrel, if crude increases by that much, then the current account deficit basically increases by as much as 12.5 billion US dollars. And the impact that it has on CPI inflation is as much as 24 basis points or 0.3%. Just a $10 increase per barrel of crude. Why is it crude? Why is crude so important? Well, there are three factors that you have to keep in mind. Number one, for a country like India, it depends on the imports of crude. We import as much as 86% of crude, and this is the dependence that we have from countries elsewhere, right? Because we don't produce that much, right? So 86% of our crude is imported. It is imported by paying in US dollars. This is the second thing, and this is prone to currency fluctuation risks as such. One, that you're going to be importing more at a higher cost, and two, you're going to be prone to currency fluctuations where if in such a case you are asked to import more crude, then your currency basically ultimately suffers because it gets what we say as a depreciation effect. And this is where FIIs come into the being. They sell their holdings because for every dollar that they sell, they're getting more money out of it, right? So what I'm trying to tell you is that with a rising paying the bill cost on a crude and the rupee getting depreciated, there is a lot between the lines that is not working in our favor. Number two, the consumer durables that you see, the goods that you see are not manufactured, a street across where you live, at least if you live in the towns. They are manufactured in industrial SEZ zones, which are miles, kilometers away, right? And these are places from where transportation needs to be done to the warehouses and then to the shops as such, to the wholesale agents, etc., etc. But then transportation too ultimately gets impacted, especially the FMCG sector. And this is where the companies are forced to take the decisions on either passing the cost to you and I, or basically affecting their margins as such. The third thing that you've got to keep in mind is the trade imbalance, because if crude oil prices stay up, then imports, prices will basically go up. The current account deficit will basically go up. Now, you must be thinking, ये सारी चीजें तो हो गई and there's nothing good that you've said. Everything that you've said basically says that with the crude rising, there are going to be more strained times ahead. That is true. That is true. But something which is also true is that this is not the India of 2014 September. Why 2014 September all of a sudden? Why is the relevance on 2014? Because 2014 September was a period when the crude had breached that $100 per barrel mark. Okay. Now, if you compare what was the scenario then, and if you compare what is the scenario now, you will appreciate where we are. Now, see this. See the table. The current account deficit then was 1.6% as a percentage of the GDP is how it is expressed. Now it is 1.3%. Forex reserves at that particular point in time in 2014 were $316 billion US dollars, which is now $630 billion US dollars. CPI inflation was 6.46, which is now about 6%. And the GDP growth, this is where the silver lining is, was about 5.9, which is now 8.4%. Now, what am I trying to say? That India is better protected against the volatilities as it was, or if you were to compare this with 2014 period, it has a better forex reserve, its growth is fantastic, its current account deficit is well manageable, it's basically looking at an inflation which is well under control. In fact, if you compare it with our neighbor, the country that starts with the P, right? The net import number of days that it has is about 7 days. That is how much it has. Back in 2014, we had a cover of about 7.5 months. Today, this cover of import, largely because of the forex reserves that we have, is as high as 10.6 months. Right? Compare this with 1990 period, where we had just about 14 days of forex reserves left. Today, we are talking about 10.6 months that we can withstand this avalanche as it is coming on us. So, India is placed in a far, far, far better position as it was as compared to 2014. Now, what about interest rates? What about it? What about interest rates? See this graph on your screen, right? What about interest rates? Well, from 2000, there are 4 times that the interest rates have been hiked by the central bank, right? See these 4 periods yourself. Now, these are the periods that are appearing on the left. I would want you to see that Nifty has given a positive return in all the 4 periods. All the 4 periods. Not only that, the average GDP growth, which is the GDP growth over the hike period, that is the period during which the interest rates were hiked, you will see has been either better or equal to the GDP growth at which point the interest rate was hiked. Now, what am I trying to say? That in a growing economy, when the growth is pretty much evident, then a rise in interest rate is something that augments the overall growth story. It doesn't cripple it. And keep that in mind, because there is a lot of chatter that interest rates बढ़ जाएगा, ऐसा हो जाएगा, वैसा हो जाएगा. कुछ नहीं होगा. These are all part and parcels and balances that are maintained in the system, right? Last but not the least, please keep in mind that the Indian growth story, and I'm thankful to an article that appeared yesterday, and credits to all the data and the information that I'm reading, to the people who have published these articles. We'll be mentioning the sources where we've picked it from. There is a beautiful article that we picked this information from, and this information was basically saying that there are 5 key reasons and why investors in India should not be worried, even with the Russia-Ukraine crisis. What were these 5 reasons? That the India Inc., the corporates, have a far stronger balance sheet as compared to what it was in the earlier times. Cash reserves have surged. Indian corporates have been able to deleverage their balance sheets, meaning that they've been able to pay off their debts. They've been able to come off, any pledging of shares that were there. Number 2, promoters are very optimistic about the business potentials ahead. In fact, if you see the data, in the past 10 years, promoters have basically increased their holding from 35% to 32% to 45%. Post-pandemic, the promoters have increased their holding in their respective companies by as much as on an average by about 3%. What does it reflect? That they themselves are very, very confident of the times ahead and of the progress their companies are making. Third, the capex has set in. Not only the government capex, but the private sector has too kicked in their capex. Large thanks to the investment cycle, the encouragement from the central government as such, because if you really see, corporates are expanding on the capex program. There is a lot of infrastructure spending that the government is doing. In fact, it is setting up a virtuous cycle in which there is a growth-led stimulus, which is largely working on the back of creating an economic growth by increasing the demand in the long term. And these are those successful levers in addition to supply-side reforms that the government is doing, where you can be rest assured that the times to come are even more exciting and better for you and me as Indian citizens. China plus one, we all know that this is something that has really opened up the gates. In fact, the green energy transition has opened up new sectors for Indian investors. Last but not the least, PLI. How can you forget PLI? This is a game changer. This is where India has just moved the next gear and moved with some momentum, right? In the end, I'd like to ask you one of the things, because this may sound childish to you, but it's very important that you answer this question. Have you heard of a stopover or a layover, right? Because if you're boarding a flight from New Delhi or from Mumbai and you're going to New York and you're flying British Airways or any other airways, I'm just taking an example, this is at least times that I remember, then at London Heathrow there is a stopover or layover of about 4 to 5 hours. Why am I saying this? What has got Russia and Ukraine crisis to do with a Heathrow stopover? Well, we firmly believe that this period is the stopover or the layover period. This is the period where the Nifty, the Sensex are taking that breather of a stopover, consolidating, and from these levels on, you will see that the indices will not only move, but move with some momentum behind them. There are many tailwinds that I discussed. Consider the current phase, that of consolidation, to be getting over very, very soon. Very soon. Don't ask me of the date and don't ask me of the momentum that we'll be seeing when this consolidation will end. But please believe me, the period is pretty much over. And from here on, you should see the indices gain the second, third, fourth, fifth gear and ultimately move beyond these 17,500 zones to be landing in the zones of about 18,500, 19 in another 12 months' time. That is a fair assumption, right? So we've tried presenting the facts to you with data, and I hope you appreciate and we hope that you don't panic, for heaven's sake, and you don't do something which you will repent for the rest of your life. This is something that we keep doing as a part of Informed Investor series. As you watch this, I'm sure that you're watching this for the first time. For the people who are associated with Informed Investor, this is not something new. We've always been there. We will be there as a mentor, as a friend to you, to be able to guide you through these crisis moments, geopolitical, inflation, health-related crisis. But we will be there to give you the facts. Ultimately, the decision is yours. Our role is to bring the facts and insights to you as they matter. Because we firmly believe that we move away from news and bring insights that you should consider. Now, with this hope, the last thing that you're asking me, what should we do? Please go back to your portfolio. Really, please go back to your portfolio and see there are many stocks that are appearing in the buying range. Open your portfolio, because this is a well-diversified portfolio of 18 to 22 stocks, in which many of the stocks are in a buying range. Please allocate your additional funds, or the funds that you believe you're wanting to invest. Please follow the allocation. Please diversify. Please do, follow the percentage allocation to the T. If there is cash in hand that needs to be maintained, your portfolio will say so. But follow it, because we spend a countless number of hours getting the right portfolio with the right mix, with the right size to you. And this is a practical advice that I can give to you as a friend, hoping that you stay healthy and you don't react to the geopolitical crisis as such. By the way, the markets are up. See you next time. Take care and goodbye.